Welcome. This is a presentation on inflation by Devraj Patel. Imagine you go to Starbucks every day. You buy $7 Starbucks coffee, you have enough money to afford that. But most people around you do not have $7 to buy Starbucks coffee every day. But one day you and everyone around you gets $1,200 stimulus check from the government. Now you and everyone around you has enough money to buy coffee at Starbucks. But Starbucks doesn't have enough coffee for everyone, so they decide to raise prices to $12, maybe even $15. Are you willing to pay $15 for a coffee? This is a classic example of inflation. Federal government has printed trillions of dollars during the pandemic last year. This extra money in the economy is producing high risk of inflation. During my research, I have came across uh, highly credible articles, videos, and interviews of highly credible people. Today, I'm going to talk about how the stimulus check provided by the government is producing high risk of inflation. Prices of everything is going up. There is a scarcity of products to sell. For example, housing market is going up. There are more buyers than there are sellers. Um, According to Zillow, average house stays about 25 days on the market, which is less than 25 days, 4 weeks. Well, it's not just housing market where there is scarcity of houses. It's other markets too. But the housing market is highly inflated because of that. Another thing, another asset that is going up is stock market. According to Deutsche Bank, about $170 billion worth of stimulus check went into the stock market. And for that reason, stock market today is highly inflated. Bitcoin last year was at $3,000. But in less than a year, because of the stimulus check, the price of Bitcoin went from 3,000 all the way up to $63,000, which is crazy. This might be interesting for you. According to, do you eat cereal every day? If so, according to Mr. Friedman at New York Times on April 30, 2021, says that General Mills is raising prices of their cereal, and they are doing this because there is a shortage of workers in their supply chain. The prices of cars are going up. Think most people buy used car because they believe that car is a depreciating asset, but it turns out that car is an asset one should own. According to US Bureau of Labor Statistics, prices of used car are up 21%, which means if you bought a car last year for $10,000, this year your car would be worth $12,100. That is $2,100 on a used car. Prices of all the commodities are going up. For example, corn is up 44%, sugar is up 55%, natural gas 60%, crude oil 79%, copper 67%, and iron 129%. This data was taken from tradingview.com, and the reason for this inflation in the prices of commodity is because there is a shortage of workers. According to an article by Yahoo Finance, it states that people do not want to go back to work because they are making enough money from stimulus check and unemployment benefits, so they are not going to work, and because of that they are unproductive. And for that reason, there is a less supply of these commodities, and prices of these commodities are going up. Let's talk about numbers. Feds try to keep inflation about 2% every year, but recent number indicates that the inflation rate was 4.2% year to year for month of April and 5% year to year for the month of March. Well, it is 5% is not that bad, because if you had $1,000 in your bank account, your money would be worth $50 less since last year. When it gets scary is when we get into hyperinflation. For example, Venezuela. Venezuela had, according to Statistica.com, Venezuela had inflation rate of 65,000% in 2018. Which means if people of Venezuela had 1,000 bolivar saved, bolivar is Venezuela's currency, in their bank account, in less than a year, their 1,000 bolivar would be worth close to $0. Do you remember the coffee example I gave you in the beginning? Well, in Venezuela in 2018, the price of coffee was around 450 bolivar. But in less than a year, the price of coffee went from 450 bolivar to 1 million bolivar. Let's look at Germany. Germany had a debt problem after the World War I. To solve that debt problem, they printed out money. And according to Mises Institute, printing out this money helped Germany get out of the debt. But in the long run, they had to go through hyperinflation, and their money became worthless. And to fix this, they had to replace their own currency. To sum up everything that I've stated so far, the stimulus checks provided by the government is producing high risk of inflation in the economy. Because of this extra money, prices of everything is going up. There is more demand than there is supply, and if people don't go back to work and starts producing enough supply to meet the demand, we could see high rates of inflation in the US economy. This was a presentation on inflation. Thank you very much.